Hey guys, Ken from Investing Made Easy here, and today I have a new series that I'm going to be calling $1,000 to $1 million. In this series, by using a set investing strategy as well as my stock picker that I have created, I will attempt to increase my portfolio size. But before we begin, make sure to like, comment and subscribe as you don't want to miss this series. So, how is this going to work? Every 2 weeks we will pick some stocks that we think are going to be successful and invest £1,000 into them. To keep emotion out of choosing these stocks, I'll be using my stock picker to help choose for me. This is going to be a long-term project, and hopefully after a couple of years we should have some good results. And finally, it's important to stay vigilant of the markets when investing. The link to my stock picker will be in the description, and let's get started. So, how do we use my stock picker? First, you can input the name of the company you'd like to invest in here. Once you have entered it in here, it will also be displayed here and here. The top section is the part which tells you whether it's worth investing in, and the center part is the bit where you need to fill in with the information of the company. The bottom section is where all the calculations take place, and which ultimately helps us decide whether a company is worth investing in. As you enter the values of the cells will change color depending on whether the value is favorable or not. At the top, the company will either get a score between minus 107.5 and 107.5. Above 90 is worth purchasing. Between 45 and 90, the company is not worth purchasing, but if you already own shares in this company, we don't need to sell them. However, if the company is in the red, if we own shares in this company, we should sell it immediately. In the top right, I have also included some helpful tools for us, such as the calculation of the average rate of change and the market cap. The stock picker works with 8 values. The first 2 are earnings growth for the previous 5 years and earnings growth for the last year. These are both important as the earnings are essentially the company's profits. A company that isn't making a profit will not see its stock price increase. Therefore, looking at the earnings history of a company can help us identify a company that may grow in the future. High earnings can also lead to a dividend payout, which is useful for creating passive income. Companies that miss earnings targets will have severe repercussions in their stock price, so you must be wary of the market at all times. We look at both a 5-year and a 1-year growth, as this gives us a more well-rounded picture of the company's earnings compared to just one of the two. Next, the payout ratio. A low payout ratio means that the company is using more of its money to fuel its growth. This is important as companies that don't reinvest back into themselves tend to stagnate. Another useful metric is the average increase of the number of shares. If a company is actively buying back its shares, it means that the remaining number of shares become more valuable. Decreasing the number of shares also increases the dividend payout per share, as there is more money for less shareholders. The P to E ratio, or price to earnings ratio, is also important, as it shows us how much we are paying for a certain amount of profits. The lower the ratio, the more money a company is making per pound that you invest into it. Now, the projected earnings growth ratio, or the PEG ratio. This is an indicator of undervaluation. While a low P to E ratio may make a stock look like a good buy, factoring in a company's growth rate to get the stock's PEG ratio can tell you a different story. The lower the PEG ratio, the more the stock may be undervalued given its earnings performance. The P to B ratio, or the price to book ratio, can sometimes be known as the price to equity ratio. This is an indicator of undervaluation as well. A low value may be an indicator of an undervalued company. Buying a company that is undervalued gives you the best odds for a higher return, as you're able to buy a larger stake in the company and therefore experience higher growth. Finally, the dividend yield. This is the yearly dividend compared to the share price. This is what percentage annually you'll get back on the shares you own. This is a great way to build passive income. This can also be an indicator of an undervalued company. If a company's dividend yield is higher than its 5-year average, it could mean that the company is undervalued. This is for 2 reasons. The company may feel that its share price is undervalued and therefore is attempting to attract investors with a high dividend yield, or that the company is doing really well and believes sharing profits with the investors is a good idea. Now I'm going to give you an example on how to use the stock picker. I'm going to pick the company Walt Disney today, as we can look at the values we should put in. The site that I am pulling the data from is Morningstar, as they give great historical data in easy to find spreadsheets. So, if we want to find earnings growth, first go to Morningstar's website and search the code for the company, DIS in this case. From here, click the tab for key ratios, and then full key ratios. From here, we are presented with a huge table of data from the previous 10 years. If we then go to the key ratios section, and then click the growth tab at the bottom, we can see the EPS percentage section. These are the values we want. The values we want here are the 5-year average from the last line here. It's 12.7%. We can then take this and plot it into our table. We then take the year-over-year average of minus 0.7% and put it into the cell next to it. Now, for the payout ratio, go back to the main screen and scroll down to the dividends and splits. Here you can find the payout ratio percentage. Select the current value, which is 21.6%, and plot it back into our table. Now, we want to calculate the average rate of the increase of the number of shares. For this, you can use my little tool in the top right corner of the screen. First, we should take the current value for the number of shares. If we look in the big table, you can find the number of shares in millions. Take the number in the TTM column. So, that's 1,537 million shares. Place that back into the recent box in the calculator. Now, go back to the large table and take the value from the 2012, which is 1,909 million shares. Put this value into the 5 years ago column and press enter. Now, on the right, you should see the average rate of change of the number. If it's negative, it just means the number of shares has gone down. Put this number into its cell on the table. To find the P to E ratio, go to the main website and scroll down to the valuation section. Here, you should find the value for the price to earnings. Take the value from current, which is 13.91 here, and put it into our table. Now, we are going to calculate the ratio of the current dividend yield over the average dividend yield. So, go back to the main site. Scroll down to the dividends and splits section and look for the trailing dividend percentage row. Take the current value and put it into the current cell in the calculator. Now, go back to the website and take the 5-year percentage average. Now, put this into the average cell on the calculator and press enter. This will give you the value of the ratio that you need. Take this value and put it into our dividend yield column. The next couple are very easy to do. Go back to the site and scroll back up to the valuation section. In the row, price per book, and take the value from the current column, which is 3.44, and put it back into our table. Let's do the same for the PEG ratio. Go back into the valuation section and select the row PEG ratio. Look for the current column and get our value, which is 1.27. Now paste this back into our table. And finally, the market cap. You can find this very easily just by Googling it, but if you can't find it, look for the number of shares and the price per share and put them into this calculator. This will give you your value for the market cap. I just took the value off a website, so I didn't have to do the calculation here. Now, if we go to the top left corner, we can see that Disney has been given a score of 82.56. This is not at our 90% threshold to be in the green section, so it would not be worth investing in today. But if we already had purchased shares in this company from before, there would be no need to sell it. Looking at the companies I have run through my stock picker today, the best options look like the Bank of America and British American Tobacco. They both have high scores of nearly 100. So today I will split my investment of £500 each way into both companies. I hope everybody enjoyed this video. Like and subscribe for the follow-up videos in which we will have a look into how well these stocks have done and proceed to invest another £1,000 into some more companies. This is Ken from Investing Made Easy, and I'll see you.